Okay, so you want to own a diamond mine, walking into a dusty pit and pulling out a stone worth more than most people's houses. The glint of something that took 1 billion years to form, sitting in the palm of your hand. That's the picture. That's the fantasy that sold this industry for over a century. And it's not entirely a lie. Here's what that picture doesn't show you. A company that invented the modern diamond market is, right now, in the middle of the worst collapse in its 130-year history. It posted a loss of over $500 million last year. It's been put up for sale and nobody wants to buy it. And the reason has almost nothing to do with running out of diamonds and everything to do with the fact that the entire industry was never really about diamonds being rare. It was about convincing you they were. By the end of this, you'll understand exactly how one company manufactured an entire luxury market out of a mineral that isn't actually scarce, why that strategy worked for almost 100 years, and why it's falling apart right now in a way that's bankrupting mines across 3 continents. Before we get into the numbers, you need to understand what a diamond mine actually is, because most people picture a hole in the ground with treasure in it. In reality, a diamond mine is one of the most capital-intensive businesses on Earth before it produces a single stone. Diamonds form inside volcanic pipes called kimberlites, pushed up from deep in the Earth's mantle over hundreds of millions of years. Finding one of these pipes worth mining takes years of geological surveying. And even then, most of what you dig up is ordinary rock. A functioning mine has to process enormous volumes of ore, sometimes tons of rock, just to recover a single carat of gem-quality diamond. You're not digging up treasure. You're running an industrial or processing operation that occasionally finds something valuable buried inside it. Here's the part almost nobody outside the industry understands. For most of the 20th century, the price of a diamond had almost nothing to do with how rare it actually was. In 1947, an advertising agency working for one company wrote 4 words that would define an entire industry. A diamond is forever. That slogan didn't describe a natural law. It manufactured one. The company behind it built a system that controlled the flow of diamonds onto the market so tightly that it could set prices almost however it wanted, regardless of how much was actually being mined. At its peak, that company controlled somewhere around 80% of the world's rough diamond supply. The scarcity wasn't geological. It was managed. That control started slipping decades ago as new discoveries in Russia, Australia, and Canada broke the monopoly, and the company's market share fell from around 80% to closer to 30% by 2010. But the pricing discipline held for a remarkably long time. Even with more diamonds coming from more places, the industry mostly kept behaving as if diamonds were rare, because as long as everyone believed it, the prices held. Then came the technology that actually broke the myth: lab-grown diamonds. Chemically and physically identical to a mined diamond, grown in a facility instead of pulled from the ground, and now indistinguishable to the naked eye. When they first hit the market, lab-grown stones were priced close to natural diamonds, positioned as a slightly cheaper alternative. That didn't last. As production scaled up, lab-grown diamond prices started falling, and they haven't stopped. A 1-carat lab-grown diamond that cost around $3,500 in 2021 costs around $350 today. That's a 90% collapse in 5 years. Meanwhile, a comparable natural diamond has held at roughly $6,000. And here's the fact that stops most first-time buyers cold. Lab-grown diamonds now make up over half of all center stones in American engagement rings, a category that was almost entirely natural diamonds just a few years ago. The market didn't shrink. It got replaced. So what does this actually mean for the economics of running a mine? Let's talk about the operating costs, because they haven't gotten any cheaper while all of this has been happening. A single major diamond mine can cost billions of dollars to develop before it produces anything. And running costs stay brutally high because you're processing enormous volumes of ore for a tiny yield of usable stones. One of the largest diamond mining operations in the world recently laid out a plan to cut operating costs nearly a third over the next several years, from roughly $9 billion in local currency down to $6 billion, simply to survive current market conditions. Its chief operating officer put it bluntly: "The way things are now, we should be closing within 3 years if we don't change something." That's not a struggling junior mining company talking. That's one of the most productive diamond operations on the planet, warning that it might have to shut down entirely. The company that built the modern diamond industry is in even worse shape. Its EBITDA loss widened to over $500 million last year, up from a $25 million loss the year before. A 20 times increase in losses in a single year. Rough diamond production fell 12% as the company scaled back output just to match falling demand. It cut its production guidance for this year down to as low as 21 million carats, compared to a prior target of 29 million. Its parent company is actively trying to sell it off, and after more than a year of searching, hasn't found a buyer because nobody wants to catch a falling business in an industry that's structurally changing beneath it. Here's where it gets genuinely brutal for the smaller producers who don't have a global brand to fall back on. One publicly listed diamond mining company that owns one of the most historically significant mines in the world, the source of the largest gem-quality rough diamond ever found, reported revenue of around $200 million last year and an operating loss of over $180 million. Its net loss came in at over $116 million. That's not a company having a bad quarter. That's a company that lost roughly 90 cents for every dollar it brought in. If you want proof of how directly this hits real people and real places, look at what's happening at that company's flagship mines right now. Severe cost pressures have pushed two of its major operations toward what analysts describe as an effective closure trajectory, putting close to 1,800 jobs at risk in a single region. This isn't a hypothetical bad year scenario. It's happening in real time as this video is being made. So let's build the two honest scenarios, because this is where the real picture comes into focus. In the good year, and by good year here we mean roughly a decade ago, before the lab-grown collapse really took hold, a mid-sized diamond mine could process its ore, sell into a stable pricing structure controlled by a handful of major players, and generate a reliable margin year after year. Costs were high, but predictable. Revenue tracked global demand, which was itself managed by controlled supply. You knew roughly what your diamonds would fetch because the entire industry was built to make sure you did. And then, over the following several years, everything changed. In the bad year, and this is essentially every year now, your mine still has to process the same volume of ore at the same enormous cost, because the geology hasn't changed. But the price you can sell into has collapsed, not because your diamonds got worse, but because a manufactured, chemically identical alternative crushed the psychological premium the entire market was built on. Your buyers, the cutters and polishers who used to compete for your rough stones, are sitting on backed up inventory they can't move at the old prices. You cut production to match weaker demand, which lowers your revenue further, but your fixed costs, the labor, the equipment, the processing infrastructure barely move. The gap between what it costs you to run the mine and what the market will actually pay for what comes out of it keeps widening every single quarter. That gap, the difference between the stable, managed scarcity decade and the current collapse, is the entire story of diamond mine ownership condensed into one number. And unlike almost every other asset we've covered on this channel, this isn't a good year versus bad year within a stable business model. It's a structural break in the business model itself. The thing that made diamonds valuable was never really the diamonds. It was the story around them. And that story is losing to a competitor that tells almost the exact same story for a tenth of the price. Which brings us to the real question sitting underneath all of this. If the asset itself hasn't changed, the geology hasn't changed, the diamonds coming out of the ground are exactly as rare as they've always been, why is the entire industry collapsing at once? The answer is that the industry was never really selling rarity. It was selling belief in rarity. And a belief is the one input in this entire supply chain that can evaporate faster than any mining company can adjust its cost structure. So here's the honest question. If one of the most dominant, most successful monopolies in the history of modern commerce can lose control of the story it spent a century building and be unable to find a buyer for itself at any price, why would anyone still want to own a diamond mine today? The honest answer is that some investors are betting the natural diamond story survives this in some smaller, more premium form, the way certain luxury goods survive mass market disruption by retreating upmarket entirely. Others are simply holding on because exiting now means locking in a loss nobody wants to accept. People used to think they were buying into something the earth made scarce. The company that built this industry knew the entire time that they were really selling something else. A story, told consistently enough for long enough that an entire planet agreed to believe it. For almost 100 years, that story was worth more than the stones themselves. Right now, for the first time in generations, it's worth finding out what happens when the story stops being believed.